To some degree, we are always gambling, always taking risks in life. If you put up $100 at the roulette table, you could lose it all if things don't turn out in your favor. But in real estate, people tend to borrow from the bank, using leverage either to their advantage or because they don't have enough cash. But what happens when those using that leverage start to see their investment turn south? You came here for the truth, so let me unveil that for you. Today we are going to look at one particular topic, and that is margin. Let's begin here by talking about it, and then I will show you the statistics, why it's important. As the name implies, securities-based loans rely on the value of stocks, bonds, or mutual funds as collateral. The most common form of securities-based loan is a margin loan. So imagine this ridiculous concept where you can actually use stocks to buy more stocks. And here, this typically allows you to borrow up to 50% of the value of the stocks in your account and a higher percentage of the less volatile assets such as treasuries or municipal bonds. So imagine that for a second. You don't need to front all that money, and you could buy up twice as much stock as you normally would be able to. This has caused a boom in the stock market to some degree. Whenever you see a bull market, you always see an increase in the amount of margin that has been created. But it won't be a big problem for everyone if there's not that much margin happening right now. But I'll show you that it is truly unfortunate, the situation we are in today. So let's look at this here. Margin debt climbed to a record high in February, a fresh sign of the bullishness for flummoxed investors trying to navigate the political and economic cross-currents driving markets. There's more in this article. Let me just discuss this momentarily. What we have here at the roulette table that I discussed at the beginning is you, in most cases, you want to bet $100 at the roulette table. You have to have a $100 cash. You put that up. If you lose it, you lost your $100. But what happens in the event that you are buying a $1 million home and you put up 20%? So you don't have to necessarily have 100% of that price of that home to own 100%. You only need 20%, let's say. And so you do that, and it's a big amount of leverage, but the bank will do that because they can always take the home as collateral. They can always take it away from you. What happens, however, if the market starts to decline? Well then, if you had put in, let's say, $200,000 and the housing prices went from $1 million to $800,000, suddenly you're completely out of cash. And that's the way this works. Your equity can evaporate very fast when you're using leverage. That's the problem. Now, in these typical margin loans, I assure you, as soon as your money starts to decline, you're going to be getting a phone call saying, you're going to have to put a little bit more cash in there. But what if you didn't? What if you just made that assumption that stocks will always rise? Well, then you'd be in a very big problem. The amount investors borrowed against their brokerage account climbed to, can you believe this, $500 billion in February, according to the most recent data available, and that's up from the month prior. Now, before we get into the actual chart, let's just cover one more part from this. With margin debt, investors pledge securities, typically stocks or bonds, to obtain a loan from their brokerage firm. And it essentially goes on to say that they don't have to, but that's usually what they do. And this is, to me, frightening because it's all fine and dandy when the market's moving upward, but that's what causes the problem when you see a market taking a nosedive every single time there's a recession or depression, you always see a nosedive. Things fall very, very rapidly. And there's fear involved. There's a lot of things that are involved here. But ultimately, the stock market rises, and even if it's rising at a rather fast pace, it always seems to drop at a much faster pace. And then it doesn't find that stability for a long period of time. It will cause a lot of pain to a lot of people who are using margin. It's not as bad to those who just fronted all the money in hopes that it would rise, but those who are using margin will be hurt tremendously by this, I assure you. Now let's look at the situation that we face today. It should be of no surprise to anyone that this continues to increase as time goes on. We are seeing a state that we have seen before. No doubt, it rose and it came down. It had risen, and guess what? It came down. Every time the same thing occurs, and it actually is getting worse as the years go on. Every time there is a recession, these indicators that I've shown you get worse. So you need to keep an eye on this. Look at margin debt. Remember that this is very important as an indicator for the health of the stock market. You also need to look into things like PE ratios and other things that I've discussed previously on this eCourse, as well as my books. But what you need to know is that leverage is very powerful. It makes people a lot of money, but at the same time, it can make people very poor very quickly. It's dangerous. It's risky, but it's up to you. That's all for this video. This is part of the Money GPS eCourse. It's a free eCourse available on my website, themoneygps.com. So check that out over there. I have a lot of free information, hours upon hours of free information there in the free eCourse. If you click on that button in the bottom left, I've got free ebooks. I've got information on there. All my YouTube videos are on there. Everything else for you to check out, that is at themoneygps.com. Take care.